Hi and welcome back to another video with me, Becky and Siren Crypto. We've covered quite a lot recently, so I thought in this video it would be a good opportunity to possibly pause just a little bit and look at what are some pretty common trading mistakes. When it comes to trading mistakes, you can make a really long list, but I thought for the purposes of this, it's going to be a short video covering the 3 most common trading mistakes. Firstly, here's our disclaimer. This tutorial is for educational and illustrative purposes only. We are not responsible for any investments made applying this information or buying or selling recommendations. Siren Crypto are not licensed investment advisors. We make no recommendations to purchase or sell any kind of coin, option or security. Any investment contains risk and is 100% the responsibility of the investor to assess the risks and rewards involved. Trading the crypto market involves a high degree of risk, and you may incur financial losses if you engage in this activity. We at Siren Crypto take no liability, assumed or implied, from your application of the information we share within our training programs. Let's look at the top 3 trading mistakes. Let's start off with number 1. You will all have heard this before, and we're going to look at a real example in a few seconds. But I think one of the big problems is people cannot trade with the trend. They see a market that's maybe doing this or this. And if a market has been going up, they can't seem to bring themselves to buy into that market. They always want to try and pick the top, so they're going against the major move in the market. And it's the same, of course, for a falling market. The market is sliding. Plenty of people are trying to pick the bottom. But what are the chances if you have a market that's either gone up for 6 months or down for 6 months that you nail the absolute turning point? It's highly unlikely, but let's take a look at a real example. Let's take a look at Link paired with Bitcoin. Now I'm working here on a 4-hour time frame, and Link really did move out to some real highs. There are so many markets we could pick when it comes to looking at trends. Now in a trend like this, you're really trading against the odds. On a strong uptrend like this, our approach should be looking to buy the dips. If you're selling short, the moves you're trying to catch are the tiny dips. On a trend like this, what are the chances that you are going to pick the absolute top? It's actually much easier to try and position yourself for maybe the next swing over the next few days, the next few hours, the next few weeks, whatever your time frame is. Trading with the trends really should be at the core of our approach, but it's one that so many get wrong because psychologically it's difficult to do. It's so much easier to identify a trend on a chart. It's pretty clear what the trend is here and to learn to trade with the trend. So there we go, we want to try and trade with the trend. Put the odds in your favour. If a market is going up at the time you are trading, look to be a buyer. If the market is going down, look to be a seller. I think the second, maybe more common problem is trading too big. People might open an account with, let's say, $1,000 or whatever it is, but they risk far too much on any one trade. If they're doing a trade where they are risking losing $250, that's a massive risk compared to the size of the account. I think it's really difficult to look at a market objectively if you're in a trade where every single Satoshi the market moves against you or in your favour is a massive sum of money to you. And whatever sum of money that is, we need to trade at a level where we're not obsessing about every single point move in the market. It's a really important part of trading that when you start off, and even if your account grows, you have to think, am I really comfortable with the level of risk I'm taking here? Because if you're not, then every time the market moves a little bit against you, you'll be panicked into maybe making really bad decisions, or maybe getting out of a trade too early or setting your stop loss too tight. Which brings me to point number 3. The third, possibly most common mistake comes to setting stop losses. First of all, if you're not setting a stop loss, you're just hoping. You're hoping that the market is going to go in your favour. You don't really have a strategy for getting out if you're wrong, and that's a real issue. If you can't admit you're wrong, then it's a real problem when it comes to trading. Now let's say you do use a stop loss because you're sensible and you think, I'm going to use a stop loss on this trade. The most common mistake when setting your stop loss is setting them far too tight to where the market is trading, and we're going to have a look at a great example in a second for this. So you don't even give the trade time to work in your favour. You're so worried about losing on the trade, you're not even giving it a chance to be a winner. So to see a real example, we're going to take a look at Matic paired with Bitcoin. This is as good an example as any to illustrate where people can go wrong with stop losses. So here each candlestick represents 4 hours of price action. The market traded as low as 190 Satoshi. And the high was 549 Satoshi. So the market has travelled through 192% of range. But plenty of people will try and trade a volatile market like this with incredibly tight stops. Let's say you're trading this and using a 3% stop, a 5% stop, or an 8% stop. What are the chances that you've got it right? The chances are you're just going to get stopped out just with the noise of the market. You're not giving your trade time to work out. Once you buy in, you think the market's going to go up and then you put a 5% stop on. You're almost asking the market to stop you out. I would suggest we need to give some thought to the size of our stops. Don't be afraid to use wider stops and trade a little bit smaller. Set your stops in logical areas rather than just buying and selling randomly and hoping the stop works out. Now, I know it's always easy to look at these things in the past, of course, but we have talked about setting stops before. We can see here where the market has kept coming back to. Whenever we see the market comes back to that point, we see the buyers come back in. If we are buying in, we have a logical place to have our stop loss. It's the other side of these old lows. So it might mean if we buy in, our stop is going to be around 9 or 10% away. We're then giving the market time to prove us right, rather than setting a stop loss that's just going to get taken out due to the normal noise of the market. There we go, the 3 most common trading mistakes. Number 1, trading against the trend. Number 2, trading far too big in terms of the size of your trades compared to the size of your account. And probably the most common, number 3, setting your stop loss far too tight. So you just get knocked out on a small move against you, which is just normal market noise. Well, we have a little bit of a different approach in this video, but hopefully it's given you something to think about when it comes to your own trading. In the next video, we'll be looking at another different trading strategy. If you like this video, give us a thumbs up. Make sure you don't miss out on all of our videos by clicking the subscribe button. You'll get notified when our next lesson is uploaded. Well, I'm Becky. Thanks for watching Siren Crypto, and I'll see you on the next video. Happy trading!